Economy Connect India channel. Today's video explains exchange rate of currency, methods of regulating exchange rate, foreign exchange market, foreign exchange rate in India, nominal effective exchange rate NEER, real effective exchange REER, liberalized exchange rate mechanism system LERMS. Major terms regarding currency. Latest value of rupee against dollar. An exchange rate is the value of one country's currency expressed in terms of another currency. It determines how much of one currency you need to exchange to get a unit of another. Methods of regulating exchange rate. 1. Fixed currency region. 2. Floating currency regime. 3. Managed exchange rates. The fixed currency regime is a method of regulating exchange rates of world currencies brought by the IMF. In this system, the exchange rate of a particular currency was fixed by the IMF, keeping the currency in front of a basket of important world currencies. They were the UK pounds, Japanese, German mark, DM, and French franc, FRF. Different economies were supposed to maintain that particular exchange rate in future. Exchange rates of currencies were modified by the IMF from time to time. The floating currency regime is a method of regulating exchange rates of world currencies based on the market mechanism, i.e., demand and supply. In the follow-up to the fixed currency system of exchange rate determination, it was the United Kingdom which blamed the system for its payment crisis of the late 1960s. Looking at the major loopholes in this system, the UK government decided to switch over to the floating currency regime in 1973. The same year, the IMF allowed an option to its member countries to opt for either of the currency systems. In the floating exchange rate system, the domestic currency is left free to float against a number of foreign currencies in its foreign exchange market and determine its own value. Such exchange rates are also called market-driven or based exchange rates, which are regulated by factors such as the demand and supply of the domestic and the foreign currencies in the economy concerned. A managed exchange rate system is a hybrid or mixture of the fixed and flexible exchange rate systems. The government attempts to affect the exchange rate directly by buying or selling foreign currencies, or indirectly through monetary policy by lowering or raising interest rates on foreign currency bank accounts. Today, most of the economies have shifted to this system of exchange rate determination. Almost all countries tend to intervene when the markets become disorderly. Some countries allow to free float their currencies with rare government intervention. The United States and the European Union are major examples of this category. Some economies have managed with flexible exchange rates to reduce day-to-day volatility. Canada and Japan fall in this category, besides many developing countries. India follows the dual currency regime since the 1990-93 financial year. Some economies peg their currencies to a major currency or to a basket of currency in a fixed exchange rate. A currency board is working well in Hong Kong, while the same failed in Argentina in 2002. The market where different currencies can be bought and sold is called the foreign exchange market. Out of the trades in different currencies, the exchange rate of the currency is determined by the economy. This is an institutional framework for the exchange of one national currency for another. This is particularly correct either in the case of a free float exchange, i.e., floating currency regime, or in a managed or hybrid exchange rate system. It is not allowed at all either in a fixed currency system or a hard fix. In a hard fix, this happens once the currency to which the hard fix has been carried out itself starts fluctuating. Indian currency, the rupee, was historically linked with the British pound sterling till 1948, which was fixed as far back as 1928. Once the IMF was established, India shifted to the fixed currency system, committed to maintaining rupee's external value in terms of gold or the US dollar. In 1948, 3.3 cents was fixed equivalent to US. In September 1975, India delinked the rupee from the British pound, and the RBI started determining the rupee's exchange rate with respect to the exchange rate movements of the basket of world currencies, pound dollar, DM. This was an arrangement between the fixed and the floating currency regimes. In the 1992-93 financial year, India moved to the floating currency regime with its own method, which is known as the dual exchange rate. There are two exchange rates for the rupee. One is the official rate, and the other is the market rate. Here, the point should be noted that it is the everyday changing market-based exchange rate of the rupee which affects the official exchange rate and not the other way around. The nominal effective exchange rate, NEER, is an unadjusted weighted average value of a country's currency relative to a basket of other major currencies. It serves as an economic indicator of a nation's international competitiveness in the foreign exchange market. An increase in the NEER signifies an appreciation of the domestic currency against the weighted basket of foreign currencies, while a decrease indicates depreciation. The currencies included in the basket and their respective weights are typically determined based on the country's key trading partners and the volume of trade with each. This method provides a more comprehensive view of a currency's value compared to bilateral exchange rates, as it reflects the overall strength or weakness of the currency against multiple currencies simultaneously. It's important to note that the NEER does not account for differences in inflation rates between the domestic country and its trading partners. To adjust for inflation differentials, the real effective exchange rate, RER, is used. The REER modifies the NEER by considering relative price levels, offering a more accurate measure of a country's price competitiveness in the global market. In summary, the NEER is a valuable tool for assessing a country's currency performance against a group of foreign currencies, providing insights into its international trade competitiveness. The real effective exchange rate, RER, is a metric that evaluates a country's currency value relative to a basket of other major currencies, adjusted for differences in price levels or inflation rates. It offers a comprehensive measure of a nation's currency competitiveness in the global market. Calculation of REER. REER is derived by adjusting the nominal effective exchange rate, which is a weighted average of bilateral exchange rates with relative price indices. The formula is REER equals NER, domestic price level, foreign price level. This adjustment accounts for inflation differentials, providing a more accurate reflection of a currency's real value and its impact on trade competitiveness. Interpretation of REER movements. An increase in REER suggests that the domestic currency has appreciated in real terms, making exports more expensive and imports cheaper. This scenario can lead to a decline in export competitiveness. A decrease in REER indicates a real depreciation of the domestic currency, potentially enhancing export competitiveness by making exports cheaper and imports more expensive. REER is a crucial indicator for policymakers and economists as it reflects a country's international trade competitiveness. By considering both exchange rates and inflation differentials, REER provides insights into whether a currency is overvalued or undervalued, influencing decisions on monetary policy and trade strategies. Rupee's real effective exchange rate climbs to 108.114 in NOV 2024 RBI report. The real effective exchange rate, RER, of the rupee increased to 108.114 in November from 107.20 in October, appreciating by 0.9%. The nominal appreciation was strong enough to outweigh the impact of unfavorable price differences, according to a report called Real Effective Exchange Rate and Its Implications for India's Trade Balance, authored by Reserve Bank of India staffers. Emerging market currencies were under pressure in November due to outflows by foreign portfolio investors, a strengthening US dollar, and rising US yields. The rupee depreciated by 0.4% month-on-month against the dollar, a modest depreciation compared to other major currencies. Despite heightened global uncertainties, the rupee exhibited the lowest volatility among major currencies. India announced the Liberalised Exchange Rate Mechanism System, LERMS, in the Union Budget 1992-93, and in March 1993 it was operationalized. India delinked its currency from the fixed currency system and moved into the era of floating exchange rate system under it. The Indian form of exchange rate is known as the dual exchange rate. One exchange rate of rupee is official, and the other is market-driven. The market-driven exchange rate shows the actual tendencies of the foreign currency demand and supply in the economy vis-à-vis the domestic currency. It is the market-driven exchange rate which affects the official rate and not the other way round. The monetary difference of the total export and import of an economy in one financial year is called trade balance. It might be positive or negative, known to be either favorable or unfavorable, respectively, to the economy. Broadly speaking, the economic policy which regulates the export-import activities of any economy is known as the trade policy. It is also called the foreign trade policy or the EXIM policy. This policy needs regular modifications depending upon the economic policies of the economies of the world or the trading partners. Depreciation. This term is used to mean two different things. In the foreign exchange market, it is a situation when domestic currency loses its value in front of a foreign currency if it is market-driven. It means depreciation in a currency can only take place if the economy follows the floating exchange rate system. In a domestic economy, depreciation means an asset losing its value due to either its use, wear and tear, or other economic reasons. Depreciation here means wear and tear. This is also known as capital consumption. Every economy has an official annual rate for different assets at which fixed assets are considered depreciated. Devaluation. In the foreign exchange market, when the exchange rate of a domestic currency is cut down by its government against any foreign currency, it is called devaluation. It means official depreciation is devaluation, a term used in a foreign exchange market which means a government increasing the exchange rate of its currency against any foreign currency. It is official appreciation. In the foreign exchange market, if a free-floating domestic currency increases its value against the value of a foreign currency, it is appreciation. In a domestic economy, if a fixed asset has seen an increase in its value, it is also known as appreciation. Appreciation rates for different assets are not fixed by any government as they depend upon many factors which are unseen. The Extended Fund Facility, EFF, is a service provided by the IMF to its member countries, which authorizes them to raise any amount of foreign exchange from it to fulfill their BOP crisis, but on the conditions of structural reforms in the economy put by the body. It is the first agreement of its kind. India had signed this agreement with the IMF in the financial year 1981-82. Hard currency. It is the international currency in which the highest faith is shown and is needed by every economy. The strongest currency of the world is one which has a high level of liquidity. Basically, the economy with the highest as well as highly diversified exports that are compulsive imports for other countries will also create high demand for its currency in the world and become the hard currency. It is always scarce. Until the Second World War, the best hard currency was the pound sterling of the United Kingdom, but soon it was replaced by the US dollar. Some of the best hard currencies of the world today are the US dollar, euro, Japanese yen, and UK sterling pound. Meanwhile, by late 2015, the IMF allowed the SDR to be denominated in the Chinese yuan, paving the way for a new hard currency which was implemented in 2016. Soft currency, a term used in the foreign exchange market which denotes the currency that is easily available in any economy in its forex market. For example, the rupee is a soft currency in the Indian forex market. It is basically the opposite term for the hard currency. Hot currency is a term of the forex market and is a temporary name for any hard currency. Due to certain reasons, if a hard currency is exiting in an economy at a fast pace for the time, the hard currency is known to be hot. As in the case of the SE Asian crisis, the US dollar had become hot. Heated currency is a term used in the forex market to denote the domestic currency which is under enough pressure, heat, of depreciation due to a hard currency's high tendency of exiting the economy since it has become hot. It is also known as currency under heat or under hammering. Government starts repurchasing its bonds before their maturities at full maturity prices. The money which flows into the economy is known as the cheap currency, also called cheap money. In the banking industry, it means a period of comparatively lower, softer interest rates regime. This term was popularized by economists in the early 1930s to show the opposite of the cheap currency. When a government issues bonds, the money which flows from the public to the government, or the money in the economy in general, is called dear currency, also called dear money. In the banking industry, it means a period of comparatively higher cost-style or interest rates regime. rupee falls 23 paise to hit fresh record low of 85.50 against US dollar. According to analysts, the Reserve Bank's stance to hold on to its dollar payments in short-term forward contracts added to the shortage of greenback, with importers rushing to meet their month-end payment obligations. The rupee fell steepest in almost 2 years to hit its lifetime intraday low of 85.80s, before a suspected central bank intervention helped recover some of its losses and settled 23 paise lower at a record low of 85.50 provisional against the US dollar on Friday due to a strong greenback amid increased month-end demand from banks and importers. According to analysts, the Reserve Bank's stance to hold on to its dollar payments in short-term forward contracts added to the shortage of greenback, with importers rushing to meet their month-end payment obligations. Despite robust sentiment in domestic equity markets, the rupee was weighed down by sustained outflow of foreign funds and rising crude oil prices, they added. At the interbank foreign exchange, the rupee opened week at 85.31 and plunged 53 paise to the lowest ever intraday level of 85.80. The unit finally ended the session at 85.50 provisional against the greenback, losing 23 paise from its previous closing level of 85.27. The rupee's earlier sharpest one-day fall of 68 paise was recorded on February 2, 2023. The domestic unit has been hitting new lows almost every day in the past couple of weeks. It had plunged 12 paise to 85.27 against the dollar on Thursday, after declining 13 paise in the previous 2 sessions. The central bank holds USD 21 billion in short-side forward contracts set to mature in December and January. Market speculation suggests that the RBI has refrained from rolling over these maturing forwards, leading to a scarcity of dollars and an oversupply of rupees. Moreover, dollar liquidity in the market remains very low, amplifying the upward momentum in the pair. This imbalance has propelled the USD-INR pair towards 85.8075 levels, said Amit Prabhari, MD of CR Forex Advisors. According to Anuj Choudhury, research analyst at Mirae Asset Sharekhan, the rupee hit a record low on dollar demand from importers towards the end of the month and outflows from foreign investors. Rising U.S. Treasury yields and crude oil prices also weighed on the rupee, he said, and projected the USD-INR spot price in a range of 85.30 to 85.85, saying traders may take cues from goods trade balance data from the U.S.